All right, welcome to a huge topic right here, which is actually currently quite easy to understand because we have already gone over a lot of things to make it very easy to understand what institutional market structure actually is. Now, to dissect that institutional market structure, let's first dissect the first word. The first word is what we have been focusing on so much, because the first word is institutional. And institutional right there is again the basics, which is offering fair value, seeking liquidity, that run versus that sweep of liquidity. And that is what market structure starts with. This is the basis again of market structure as well. So all we now need to understand is how this then correlates with the market structure. So we need to understand the market structure, institutional, the fair value areas, that we will combine them with the market structure. Now, moving on towards the next slide right there, we now see market structure. And when we talk about market structure, we talk about these two things. We talk about intermediate term highs, intermediate term lows, so ITH, ITL, and we talk about STH, STL, which stands for short-term high, short-term lows. Those create market structure. So let's quickly look at the market right there, how that actually looks like. Here on GBP US dollar on the daily time frame, we see this high right there. That is an intermediate term high. We see this low right there. That is an intermediate term low. Why is this an intermediate term high? And why is that an intermediate term low? So they all are swing highs and swing lows. So when we talk about market structure, it's always swing highs, swing lows. No matter what the intermediate term high, intermediate term low, short term high, short term low, whatever it may be, it's all swing highs and swing lows. The only difference is right here that an intermediate term high is this swing high right there with a lower swing high to the left of it. So, for example, right there. And a lower swing high to the right of it as well. So, sitting right there. That creates this intermediate term high right there. Now, you can also argue, well, this is also an intermediate term high then right there, right? No, it's not. Intermediate term highs, intermediate term lows are outsiders. They are the fair value areas actually, which what we're going to go over. So this right here is not the intermediate term high because we have just an intermediate term high right above it. And when we have an intermediate term high right above it, then that becomes the intermediate term high right there. Now, looking at the intermediate term low, it's the same exact thing, just reversed. So right here, we have this swing low right there with a swing low higher to the right of it and a swing low higher to the left of it right there. That creates the intermediate term low. How we can get more specific about what the actual intermediate term high, intermediate term low is, that's exactly the things we're also going to go over in the next slide. Now, everything in between that intermediate term low and that intermediate term high is a short-term high. So a short-term high is, for example, this high right there, short-term high right there, short-term high right there, and short-term high right there. All the swing highs we have right there is just simply a short-term high. Then all the swing lows we have sitting right here are just short-term lows right there. And we see another short-term low right there before we deliver into the intermediate term high. So these are intermediate term highs, intermediate term lows, and short-term highs and short-term lows. Now, that again is why I mentioned in the beginning, this is a huge topic, but we've already gone over so much that this is well, I hope this is quite easy to understand when we are going to talk about institutional market structure. So now we have to look at it from the perspective and how it correlates then to offering fair value that run on liquidity. So that intermediate term high towards intermediate term low right there, the area from the intermediate term high towards the intermediate term low or vice versa is now the fair value area. So the example we just had on GBP US dollar, the intermediate term high towards the intermediate term low is actually the fair value area. So that is where we are going to offer fair value. So this fair value area is what we expect to hold, not the intermediate term high or intermediate term low. And what I mean by that is oftentimes people have it wrong about market structure, that, and in a sense that it's not necessarily wrong, but if we expect an intermediate term high or intermediate term low to hold, we expect the fair value area to hold. So we expect us to offer fair value to then continue higher. We do not expect the actual intermediate term high or intermediate term low itself to hold. I expect the fair value area to hold, because that is institutional market structure. If we're just talking about market structure, then we're talking about, I expect this intermediate-term high, intermediate-term low to hold. But with more accuracy, it's now called institutional market structure, because we know if we are not offering fair value anymore, then the intermediate-term low is not something we expect to hold all that time. No, it actually becomes the target, right? So that's very important. Now, then right here, we have a new fair value area, new FVA. Expect a new fair value area to be created off of the previous one. So we simply expect offering fair value to then continue higher or continue low, right? Then short-term high, short-term low. Short-term ranges, so short-term high with a fair value gap in it, is a short-term range. That is also known, what we've already gone over, an order flow range. So short-term range and an order flow range are the exact same thing. Same for short-term low. If it creates a fair value gap higher, that is a short-term range and also an order flow range. So you can refer to it however you want. It's the exact same thing. Those short-term ranges and order flow ranges will guide us there. So let's look at this and let's look at this example in the chart. All right, here we are on New Zealand dollar, US dollar, also on the daily time frame. And there's quite a lot of things going on right here. But if we now clear that up with, again, this intermediate-term high that we have sitting right there and this intermediate-term low. Then once we reach this intermediate-term low, we either reach an intermediate-term high or an intermediate-term low, what the actual target was. Then right there, once we reach that intermediate-term low, we, from now that intermediate-term low towards that intermediate-term high right there, that creates the fair value area. So that is now where we can actually look to continue lower off of. So if we were to make a retracement right here, and we have a fair value gap, exactly what we went over in the basics, we have a fair value gap overlapping, all the things we've gone over thus far, then right here, we expect this intermediate term high to hold because we expect the fair value area right there to hold, to then continue lower off of that. So this, again, this offering fair value, the run on liquidity, nothing really changes in that. And what I mean by that is it's essentially looking at the same thing that we already went over in the basics. What we now add into it is, again, what we went over in the previous video as well, those fair value gaps. So those create those short-term ranges. So what I mean by that is right here, if we now retrace back into that fair value area right there, we can potentially go into the lower time frame right there to find short-term ranges, order flow ranges right there to continue lower off of that, to then reach again the low we created right there. So what does that look like? Here we are on crude oil on the 4-hour time frame, and we have taken this intermediate term high right there. We get again the great signs that we might be running that liquidity. Perfect. So right here, we also have this intermediate term low right there. Now that intermediate term low is now the protected low, but actually the fair value area right there is what we are expecting to hold. And why that is so important is exactly what we're going to go over in the next slide as well. So right here, this is now the institutional market structure where we can expect higher prices from. Now, where do we apply those short-term ranges, those order flow ranges, the short-term high, short-term low, is right here. Once we find the area that we can continue higher off of, for example, we drop down into the 15-minute time frame, the same exact thing happens, because now on the 15 minutes, we have this intermediate term low right there. We have this intermediate term high right there. And we can do the same exact thing over and over and over. Short-term highs, short-term lows are intermediate term highs, intermediate term lows on different time frames. That's why time frames and combining the time frames is a crucial part. It's arguably one of the most important parts, because if you get lost in all the time frames, then it's going to be very difficult to actually navigate price action as well. So everything is fractal right here. Now, if we now look at short-term ranges right there to continue higher, short-term lows to hold, then right here in the delivery from this intermediate term low towards that intermediate term high, because we expect this intermediate term high right there, well, intermediate term low to be respected, the fair value area to be respected, then every short-term low, every swing low with a fair value gap in it higher right there is what we can look to trade off of right there, the new one, and then the new one sitting right there as well. Then we have a new one right there, I picked this swing low because that swing low is responsible for actually creating the fair value gap. So that is the order flow range right there, what we can continue higher off of. This one gets swept right there. This one right there. Then we have, let me see, this one right there before we reach the intermediate high. And afterwards, we see the same exact thing. So after we reach an intermediate high like that, the short-term ranges, those short-term lows, they are not likely to get respected again. So they are not, we can't expect short-term ranges, for example, this short-term low right there, to now hold again and to push higher and to keep pushing higher. No, once we take an intermediate high or an intermediate low, we need to take a step back. And can a short-term low right there, short-term range, hold to push price higher? Yes. But what happens? Well, the thing that happens right here is that most likely, the more time expands, the more fair value gaps we are creating. So the further time goes on, time's always ticking, the more fair value gaps we are creating. So these short-term lows right there are not in context anymore of whatever maybe at right here, maybe a 1 hour value gap, maybe a 4 hour value gap. So we can reach into that, offer fair value again to then, we see right here, to then continue higher again off of that. So that is why oftentimes, and you'll hear me mention that in old videos, after an intermediate high or intermediate low is taken, we most likely have a bigger retracement. And that is true because we are offering fair value again to then continue higher again. Those short-term lows, short-term ranges will not hold if you do not understand where to use them. That is slowly working towards entries right there. Because those short-term lows will hold if we are targeting a clear intermediate term high. So in the middle, once we have an intermediate term low confirmed, we create short-term lows right there and we have an intermediate term high as target. That is where the short-term lows actually will hold right there. How do we confirm an intermediate term low? All things we're going to go over as well. Now, right here, let's see if we did have any fair value gap right there. And what we see is we have this 1 hour fair value gap sitting right there, which we can then continue higher off of, because that is the closest fair value gap that's overlapping with the fair value area right there with the bodies, which we can continue higher off of. And then again, we do the same thing. The only thing that changes right here, and you probably notice it, I went from the 4 hour into the 50 minute, from the 1 hour into the 5 minute. Only thing that changes is the time frames that we're looking at. So here right now, we have 5 minute short-term ranges that hold. We have this intermediate term low, we have this intermediate term high right there, and we have 5 minute short-term ranges that are holding. So this one right there, then we have this one. They keep getting very close to the lows right there, quite funny. But then eventually they keep holding. Now right here, why does this short-term range right there not hold? Because this, again, is not in what we're going to work towards in the next week. It's not in context anymore. So we have already taken the intermediate term high right there. So we want to create new context. We want to zoom out a little bit again. And we want to see, what are we dealing with actually? Well, we have a 50-minute fair value gap sitting right there. Do we have someone on a 1 hour actually? Let's see. No, we don't. Okay, interesting. So right there, the 15-minute is what we can now use to then continue higher off of that instead. We can use the fair value area we have right there to then continue higher. And again, now we might go into the 1 minute time frame. So on the 1 minute time frame again, and funny thing, by the way, what I mentioned, right? Short-term lows on one time frame are intermediate term lows on another time frame. So this low right there that we create is a 15-minute short-term low, and towards that high is 15-minute short-term high right there. But on the 1 minute, that is an intermediate term low and an intermediate term high. So this right here is an intermediate term low where we create new short-term ranges right there that hold until the intermediate term high right there on the 1 minute. So it's all relatively seen. That's why it's called relativity theory if we talk about time frames, because it's relatively seen to which time frame we are looking at right there. This is how we want to go about the offering fair value and that run on liquidity. This is again a setup. It's almost like we're constantly working towards the next video. So the institutional part that we have gone over in the previous week as well was working towards the market structure. The market structure, the institutional market structure right now is setting us up really good to understand the next topic context, to then understand the next topic entries. So Understand the intermediate-term highs, intermediate-term lows right there, short-term lows, short-term highs, how we are moving towards them as well. Now, once we have a brief understanding of that offering fair value and a run on liquidity, I want to go over arguably the more important topic in institutional market structure, because I believe this one is understandable. As in, whenever we play something out and whenever whenever is like a utopia, we just play price action and it's very nice, it's very clean, it's quite easy to understand. But the difficult thing to understand is when things are not going as planned, when things are not holding, and we need to adapt, we need to react. And that is where we need to seek liquidity right here, and we need to react to the sweep of liquidity. This is the, arguably, of course, personal preference for me. For me, this is the harder part right here. Now, first things first, we have the FVA, we have the fair value area again. So we understand already from an institutional perspective, if we're not offering fair value at the fair value area right there, then we might be sweeping that liquidity instead. We might be continuing lower or continuing higher, relatively seen to what bearish or bullish price action is telling us. Now, right here, the next step is a confirmed intermediate term high or low right there. So confirmed intermediate term high or intermediate term low coming into a fair value area. Okay, what does that mean? That's quite interesting. That is where we're going to now look at how can we confirm an intermediate term high or intermediate term low. Target intermediate term low or intermediate term high. The opposing intermediate term low, intermediate term high now becomes the target. Short term high, short term low will hold until the target is met. So what does this look like in the chart? So right here, I have two case studies I want to share with you as well. Actually three. Then right here on GBP US dollar, what do we see? We see this fair value area. So we have the intermediate term high right there on the left, intermediate term low on the right there. And then after we have that creates the fair value area, right? We can see we have early signs of a sweep. Now that right there is where I marked out lower prices, where we can expect lower prices right there. And I'll tell you why in a bit as well. Then the second case study right here is where I'm talking about gold. And gold right here, intermediate term high on the left, intermediate term low on the right side right there. That creates again the fair value area. We can already see very aggressively moving lower right there. Now that is where I marked out. We can also move lower right there already. So why have I marked out those two specific pairs right there? And what makes it a sweep? How do we confirm that intermediate term high to then target the intermediate term low? So on GBP US dollar on the daily time frame right here, once we reach this intermediate term high, we know again from that intermediate term high towards that intermediate term low, that right now is our fair value area right there. So if we want to offer fair value, we will retrace back into that fair value area, which we can now mark out like that because that is overlapping, or the wick is not overlapping with the fair value gap. So right here, if we now want to continue higher, we can continue higher off of that. What do we see? Well, we retrace quite deep into this overall area. So when we retrace quite deep into this overall area, can we still look to continue higher? Yes, as in it's only first sign. Again, remember the institutional part where the sweep is not confirmed just yet. We don't have a sweep confirmed just yet. The same as that we do not have an intermediate term high right there confirmed just yet. So what I mentioned on the previous example with crude oil, and that I want to see an intermediate term low get confirmed to then continue higher or continue lower. That is, or continue higher with an intermediate low, of course. That is the confidence right there. That is how we can confirm that it's actually a sweep as well. So right here, we now have this intermediate high and that intermediate low. We, again, and the reason I emphasize on that so much, that intermediate low is not necessarily protected. The fair value area is protected. As in, we should offer fair value to continue higher off of that. Where a lot of people go wrong, like I mentioned, is still trying to look for longs right there, since we have an intermediate low, and that intermediate low should be respected, right? Well, that is market structure, and that is market structure for pupils, for rookies, for people that just came looking at trading for the first time. But if you understand institutional market structure, you can get a lot more accuracy right here. So this intermediate low is actually the target right now, because two reasons. We have this potential sweep of that high right there. So we are not offering fair value anymore. So we are most likely seeking liquidity in the form of that intermediate term low, which is the fair value area low as well. And the second reason is we have now confirmed this intermediate term high right there. So this intermediate term high is now confirmed by having a fair value gap lower right there. But not only that, we have a retracement into a premium rate and then a new fair value gap lower right there. Now, at this moment in time, do we have a fair value gap lower right there? No, still 5 hours until we confirm that fair value gap. But I can confidently say it's very unlikely that in this day, we are going to retrace into that fair value gap right there. So that is quite similar, right, to order flow confirmed as well. It's the exact same thing. So this is the funny thing where market structure and order flow, they are very much correlated. As in when I talk about order flow ranges, I also talk about short-term ranges. When I talk about confirming order flow, I talk about it confirming an intermediate term high, intermediate term low. So right here, this confirmation of the intermediate term high is seen through the order flow confirmation. Fair value gap lower on the first range. Second, retracement back into premium rate. Then a new fair value gap lower off of that. Order flow, retracement, premium rate, order flow. That is, again, the same exact thing. And that is how we confirm the intermediate term high right there. And that is how we confirm then in turn as well, how we now want to deliver into the intermediate term low sitting right there. Where the previous video understanding also comes in. Because right here, how do we now want to deliver into that intermediate term low? Well, which fair value gap can we now look to continue lower off of, right? Do we have a breakaway gap? What kind of gap? What is the third candle telling us? That is how we can now look to deliver into that intermediate term low. So the intermediate term low is not protected just because for the sake that it's an intermediate term low. No, it actually is the target. So that, again, same thing with order flow. The lot, oftentimes, the last line of defense, the swing low is not always protected. It actually oftentimes also becomes the target instead. Very important to understand. Now, right here, the short-term ranges, the short-term high right there is now the ranges that will hold until we reach that intermediate term low right there. Now, once we reach that intermediate term low, the cycle essentially repeats. Why does the cycle repeat? Because from this intermediate term low towards that intermediate term high, that is what? A new fair value area. So once we either run or sweep that liquidity right there, depending on what we do, we can now determine, do we want to continue lower or are we sweeping to then continue higher and doing the exact same thing like we did as well right there. Now, there's a funny thing though, because we do not have to sweep liquidity. It does not have to be a visual sweep in order for us to understand if a fair value area will hold. Before we go over that, I want to go over as well the second case study that we did was gold. All right, right here we are on gold on the 4-hour time frame, and again we see this intermediate term high right there. We see this intermediate term low. We take one side, an intermediate term high is taken right there. Once we take that one side, initially might look like a great run on liquidity to continue higher off of that. After that, we immediately create a lot of resistance coming into that. Now, once we create that resistance, we can commonly say we are potentially not offering fair value anymore to continue higher. I believe that we are going to continue lower towards the intermediate term low right there. So what do we do? Well, right now we can see, is this intermediate term high right there confirmed? Well, we have a swing high lower to the right of it as well. But we need, again, right here, the fair value gap lower right there, retracement into the fair value gap, and then a new fair value gap lower off of that. So right here, we see this fair value gap, which we mentioned in the case study, and then we see a retracement back into that to then create a new fair value gap lower off of that. That is perfect. And that is where we can now exactly continue lower off of. Intermediate term highs confirmed. Now we have short-term highs as well to deliver us there. So these short-term highs right there, and the short-term high again is an order flow range. So I want to have a fair value gap in the leg. So this can be a short-term high, but it doesn't have a fair value gap lower just yet. Now these short-term highs, what are they on the lower time frame? They are intermediate term highs on the lower time frame. So on the lower time frame, essentially what we're doing is we're doing the exact same thing. But why does this fair value area right there, for example, that one not hold? Because it's not in context of the 4-hour. So the 4-hour right there has stronger fair value gap. So we need to make sure that we are trading off of those short-term ranges on the higher time frame. because they will be in context. Now, right here, what do we see? Intermediate term high to then intermediate term low right there eventually. And where can we now continue lower off of? We had that 4 hour value gap, which we can continue lower off of. And here we have a 15-minute value gap after that. Same thing. Same thing happens. 1 minute time frame right there. What do we see? We have this intermediate term high right there, which is a short-term high on the 15-minute time frame right there, and this intermediate term low right there to eventually continue lower off of that. Now, can you go into the second time frame? Well, you can. Would I advise it? No. Let's just stick to these time frames for now. Let's first master these time frames before we do anything like that. Now, that all leads to the understanding that this intermediate low is a target. But not only that intermediate low, because we already determined on the 4 hour time frame that this intermediate low right there becomes a target. So we have targets in targets in targets. Perfect. That's exactly what we want to achieve. Then right here, we can now continue lower towards that intermediate low because we have a confirmed intermediate high and we have signs of institutional part that is seeking liquidity and not offering fair value anymore. So the institutional market structure, the sweep or the offering fair value, and the market structure right there, the intermediate term high is confirmed to now target the intermediate term low right there. Perfect. Now let's go over the example where I mentioned we do not need to have a characteristic of a sweep for us to see that a fair value area will likely not hold, or at least we have the probabilities in our favor. So what do I mean with that? Here on Bitcoin, we have a beautiful example. I really like this example right here. And if we take a look at this low right there first, we see we are creating those fair value areas again. And we can also see, of course, that we are now incorporating market structure right there, intermediate term low, intermediate term high right there, fair value area. We can continue lower off of that. Afterwards, we create this new intermediate term high right there with that new intermediate term low. So here, intermediate term high, this intermediate term low right there. So if we want to continue lower, ideally we should already continue lower, but we do not do that. We continue higher right there. This is forming a new fair value area right here. Fair value area sitting right there. Let's mark the overlapping part right there. Perfect. So that right there is now our fair value area, where we can now potentially continue higher off of based on institutional market structure, right? Yes, but what do we see as well? Whilst coming into this fair value area, what are we doing right here on the 1 hour time frame? We are confirming an intermediate term high right here on the 1 hour time frame. So this high right there has a fair value gap going lower right there. After that has a new fair value gap going lower. So as soon at the same exact moment that we come into the fair value area right there, we have confirmed order flow going lower on the 1 hour. We have confirmed an intermediate term high right there going lower into the fair value area. Now, the thing right there that is important to understand, that is resistance, that intermediate term high. So right now, since we have confirmed intermediate term high, also exact same thing, confirmed order flow going lower into that fair value area, we have now a lot of resistance running into that fair value area. So is it very logical for us to exactly stop right there to then continue higher? No, it's not very logical at that moment in time. Where the difference between this example and the other examples on crude oil, for example, is that we never had an intermediate term high confirmed on the time frame of the fair value area that we were looking at to then continue higher. But here we do have an intermediate term high confirmed right there coming into the fair value area. Resistance determines that retracement. So here, if you want to look at higher prices, I would want to see more confirmation, potentially even on the same time frame right here, an intermediate term low confirmed before we do anything else. Do we have an intermediate term low confirmed right here? No, we do not. We just have this fair value gap higher, but no intermediate term low is actually confirmed at this moment in time. All right, well, then eventually we continue lower, where we can make the argument again, well, do we actually want to continue lower right here, where the intermediate term low right there of the original fair value area becomes the target again? Because we have a confirmed intermediate term high right there, can potentially continue lower off of that. So the fair value area that we had right there was already a little bit more suspicious. So we already want a little bit more confirmation than usual right there. Where now the short-term highs, short-term ranges, the order flow ranges, is what we can continue lower off of. So this is where we now use our skills, the fair value gaps again, where how far can we retrace? How far can we actually look at the 2-candle rejection? Things like that to then continue lower and target this intermediate term low right there. So the seeking liquidity, the sweep variant right there is, again, there's quite a lot of variables going into it. So there's not just one thing where I can say, all right, it's only this. No, the market changes. Where what we just saw when an intermediate term high is actually confirmed right there, and we haven't swept that fair value area just yet, that is still suspicious. So the suspicion starts at either the institutional part or the market structure part, where the institutional part is, again, once we do not offer fair value, then most likely we are seeking liquidity. That's suspicious. But like we just saw on Bitcoin, if we already have a confirmed intermediate term high coming into a fair value area where we expect us to offer fair value to then continue higher, that is also suspicious. So again, it's institutional market structure. They help each other. The market structure and the institutional part, they help each other. Where if institutional agrees that we are sweeping and we are not offering fair value anymore, and market structure is a confirmed intermediate term high, both is perfect. You want both right there to actually confirm that sweep of liquidity. That is the exact thing we are looking at. Now, that right there is where we now can go over practice. Practice right here, and the way I would want to practice this is mark out the fair value area. So any chart, any pair, any time frame as well, you can just, again, the time frame right now, we will learn how to combine them exactly as well later on. Then the time frames right here doesn't really matter. If you go into the 1 minute time frame to do it fast, perfectly fine. Go into the 1 minute time frame. Mark out the fair value area right there. Study how institutional market structure delivers in correlation with that fair value area as well. So will we respect that most likely, or will we sweep it to then continue higher? What are the intermediate term highs, intermediate term lows telling you right there of that fair value area? This is going to set up very nicely and beautifully for the next week topic, and that is context. Context the boundary and context the target, where eventually that context leads to, of course, foundational level number 5, entries, which is of course next month topic as well. All right, perfect. Thank you.